this is going to be more than a quick thing. Like it could have been if inflation was going to get squashed here, prices maybe they move down from like July to July, but by July 2023 things are, we'll call it back to normal. Like that doesn't seem to be the case here. This is going to be a longer difficult environment.
I'm Drew Breneman, and this is the Rise and Invest podcast. I bought my first two properties as a 19-year-old with my own money that I earned from an online business I started in high school. I've now grown my portfolio from that first duplex to hundreds of millions of dollars of investment property. My goal with this show is to give you the resource I wanted when I first started out. Subscribe to our podcast where I break down real-life stories, tactics, strategies, and current market information you need to be a successful investor.
This is the Rise and Invest podcast. I'm Drew Breneman, and this episode's going to be about the state of the market. Shooting this the first week of October 2022, and a lot's changed in the real estate market the last 6 months. So last week I was at a real estate conference for UW-Madison. They have actually the number one biggest alumni group for that whole college is the Real Estate Alumni Association, and every year they have a conference in September. They switch off between Chicago and Madison. Got off easy this year with it being in Chicago, and then also was at another event earlier in the week. So I have a lot of market intel. I haven't really shared much with the podcast listeners here on what's been going on. Let's say day to day in the real estate market. It's been more of like a general podcast about how things work, and not like any sort of market overview of what's going on. So I want to get on here and shoot one of those. And so I guess before I dive into, if you haven't heard, we rebranded as Breneman Capital. So check out our new website, breneman.com, B as in boy, RENEMAN.com. And so same team, same strategy, same everything, just a new name. So check it out. Same blog on there, same downloads. So with that out of the way, everyone's using terms like the market's shifting or it's becoming more balanced. Or someone recently told me it's a good market to be a buyer and a seller. Like that's all BS. So the market's down. It's not down just because of interest rates. It's down for a combination of factors. You have high inflation that we need to beat. You have the looming or a recession that we're already in. It depends on how you want to define it, but in terms of a recession, you have the high rates and you have the growth slowing. And honestly, for value, is probably the biggest piece of that, in my opinion, is the growth slowing. Meaning, let's say a lot of these deals people are buying, they're assuming, okay, my rents are $100, and then they're going to grow 3 or 4 or 5% every year. I have buddies that work at these institutional real estate shops. Let's say they buy industrial, and for the last 10 years, let's say in the Inland Empire, rents have gone up like 10% a year. Like in the market, let's say they cover. I was just talking to one of my buddies that covers that. If you start taking that growth out of that market, you're not going to pay anywhere close to the same price, even if interest rates are the same. So things are a lot different, not just because of rates, but because of the growth coming out of the market. Because if, let's say you're assuming your $100 rents are going to go to 103, then 106 something, just 3% growth. If you say, you know what, why don't they stay flat for 2 years while we fight inflation and rates go up and we have a recession? Your deal looks a lot different value-wise. So you're not going to pay the same value today. Then throw on top of that, well, if interest rates are higher, I should have an even more conservative valuation. So values are definitely down. It's a time like this where you need to have a steady hand on your deals. I think back to 2007 and 2009 and 10 for me, and I had bought a deal at what really would be the peak of the market for Madison, Wisconsin, where I bought it. It was March 15th, 2007 is when I bought it. And in 2009 or 2010, I don't remember the exact year, was thinking about selling it. I had moved to Minnesota and then to Illinois, and I was still managing it myself remotely, which was a colossal pain. I was getting phone calls with the building caught on fire once. I guess that was later than that, but just there was constant headaches, being a property manager, especially being out of town. And when I got my broker price opinion on it, I did well with the deal in terms of like I raised the value before the market dropped, or my value increase was sort of just wiped out by the market dropping. So I would have been able to sell it and basically pay off the loan and pay the broker and walk out of there with no money. So I thought, well, why would I ever do that? This is real estate's a long-term investment. This property still cash flows. I had I wanted to come up with a plan. I had a 5-year arm on that loan. So I knew my rate was going to change in 2012, which I was very worried about. So I was thinking about selling. Long story short, fast forward to 2017, I held the deal. I reinvested in the property. I improved it. Eventually changed out all the appliances and just did quite a bit at the property. All the bedrooms were carpeted, switched out to vinyl, painted better colors, just did a ton of things. But I sold the property that I bought for $670,000 in 2007 for $1.22 million in 2017. So I just wanted to share that story with you to say like things are down, and we'll get into how much and what's going on. But where now is when you want to have a steady hand. You don't want to be panic selling. You need to be, if you're going to own something for a year or two, or that was your horizon, like I'm going to buy this thing, then we're going to do whatever to it, and we're going to sell it in a year. That's out the window. Now you need to shift to a longer term hold, and hopefully you have a fixed rate loan on it. Even the deals that we bought this spring, all of them except for one, we did at 3.5% fixed for 5 years. So those now, if we were thinking we're doing those for a 3-year hold or shorter, those all turned into 5-year holds. Now we need to ride this out, get to the other side of it, and we're paying below market interest while we wait. So I had emailed our investors, about a month ago, saying the market's down anywhere between 0 and 20%, depending on the product type and the quality of the property. After talking to more people at the conference, and then also just with the most recent run up in rates. So just to refresh, we're shooting this the first week of October 2022, with rates running up at the middle and end of September because of the inflation number not coming down. That's going to make rates be higher longer, which is not helpful to property value. So there could be another leg down from here. So I would say I would now, after with that happening, I'd revise it and say I think really all properties are down 5 to call it 25%. And then for some product types that are really out of favor, office, hotels, some types of retail, I mean, those deals aren't even trading, so we don't even really know the price. So at least for the stuff that has traded hands, that's where things are coming in, say 5 to 25% down in value. And again, that's not just because interest rates went up. That's the growth is coming out of the market. There's a looming recession. Like this is not, it's not just one thing. Like in 2018, rates went up slowly throughout that year from in the 3s to in the 5s. Values did not fall at all in 2018. They went up. It was a slow, steady increase in rates while still rent and other things were increasing steadily. So it was, values were supported. Values still went up that year, even though interest rates went up. But interest rates went up so fast this year. It was the fastest rate of change ever for treasuries. And everyone always talks about treasuries because that's what the long-term loans are priced off of. If that's never been explained, a lot of lenders will say you want to do a 10-year fixed loan. They'll even quote your loan as a certain percent over the 10-year treasury. So they might say it's a 10-year treasury plus 200 bips. So that just means 10-year treasury plus 2%. So when the 10-year treasury was, in the around 2, that you do your math, that's a 4% interest loan. Well, now the 10-year treasury is at 4. In your 4 plus 2, now it's a 6% loan. So, and on top of that, banks, they have a lot of pressure on them and other lenders because their customers are moving deposits out to put into treasuries because they're paying a good return now. 2-year treasuries 4%. So now the banks, they want to increase their spreads because they have less money and they need to make more money off what they have to lend. So your 10-year loan that might be 10-year treasury plus 200, that turned into a 10-year treasury plus more than 200, and the 10-year treasury basically doubled. So I don't have the rates in front of me, so I don't. But that's roughly what had happened, and why we're talking about treasuries all the time. If you listen to other podcasts or people in real estate, it's because that's sort of the underlying thing that's driving the long-term borrowing rates, and that's the 10-year treasury. Really, not much that's quoted off like a 2-year treasury or other stuff. So I guess kind of running through what I learned, let's say, talking to folks at the real estate conference and just others in the market. I probably spoke to, like, last week, like at least 50 to 100 people. I mean, because I had another event where our law firm had a baseball game outing where there's a lot of sponsors and owners, investors there. And then also this real estate conference. So office, there's no bids on deals, so they don't really know the price. Those deals are pretty much not sellable now. They already were tough, where the whole work from home thing, but now especially things are are totally like a mystery there, and what the price change is going to be. There's been no and there's been really no big deals happen either. That's another thing. No matter what product type, there haven't been any big deal sell in office, retail, industrial, multifamily. No, nothing that sizable has traded hands. So a lot of folks that, let's say, if they work at an institutional shop and they do $1 billion type deals, they would say we don't know what the prices are because there hasn't been anything like in our price range change. But in terms of the private buyer side, what I've saw and heard others talking about, like, I do have that info. And one of the buddies at the conference, he covers industrial in California, and where he buys, the cap rates have changed from 3.5 to 4.5. If you're not familiar with the cap rate, that type of change, that's a 22% drop in value. Another industrial investor that I know covers the Midwest. Their cap rates are higher, so that means there'll be more cash flow, more current yield. So then that was pricing in less growth if it's a higher cap rate, as that's why, because if it generates more cash flow, that's the investors looking to that for their return, not so much just growth and price appreciation or the future. On that, he thought the value really hadn't changed much, so he was still taking this deal to market and thought he would get basically the same price. So we'll see what happens there. You could kind of say the same thing almost for Chicago apartments. Like, those haven't gone up that much the last, call it, 5 years. So then there's less, there's no like bubble forming, in Chicago apartments because they didn't go up that much. So there's not as much room to fall. So, that, and I'd say one more industrial data point, developer that I know, they had built a suit for industrial deal for a Fortune 50 company, basically, trying to keep this somewhat anonymous, in the Midwest. And at the start of the year, brokers were telling them that's going to sell at a 4 cap, maybe a high 3 cap, 4.0 cap, let's say, used for your underwriting. And now the broker's telling them that would be a 5.5 cap if we have any buyers at all for that. And that would be a 27% drop in value. So now on the multifamily side, talked to a few folks where they cover the whole Midwest, and they're saying values are down 10 to 15% everywhere. And then Chicago, like I was saying, I haven't heard that big a drop. Most people you talk to, they think the values are basically the same. And then what's becoming really popular are these loan assumption deals. So that's not just in Chicago, actually. So just to back up, one move you can make if you want to think, okay, what can I buy? What's the strategy here? I guess this is, a big tip on what you could buy. There are a lot of commercial loans are assumable to the next buyer. So interest rates went up, but if someone, let's say, financed a property in 2021, they might have like a 3% interest rate, and if they still want to get out of that or sell, then you can assume their loan and you'll have the 3% interest rate. So keep that in mind. Look for assumption deals. We're actively doing that now, because any of those will be lower rates than what you get today, and the loan's already in place. So it's, you have less risk on like the lender not being there at the closing table because they already made the loan. So back to Chicago though, I mean, really it's I don't know if there just haven't been enough trades or what, but it's harder to say how much that's down. Seems like a little less than the rest of the Midwest, but it didn't go up as much as the rest. So that would make some sense. Phoenix, the deals we were looking at, those were all 3.5 to 4.0 caps when we, let's say at the start of the year. And now most things are trading around a 4.5 cap that we've seen clear the market. A lot of people in Phoenix and other places, though, they've traded up in quality. So that's another piece of advice to keep in mind. When I had started in this business, we would go on these webinars, and they would be put on by the brokerage shops, Marcus and Millichap or CBRE, what have you, and they'd give you a matrix, and it would say like a cap rate matrix, Chicago downtown Class A, and buildings are ranked. They're given a rating, let's call it Class A, Class B, Class C. A is the nicest, B is the next, C is the lowest end property. Has to do with the physical condition, the location, the tenant type, the tenant quality. But the cap rates were all different. So there'd be a matrix, there'd be 9 different cap rates on there. Class A, downtown Chicago, be the lowest, and then Class B a little higher, downtown Chicago. Class C a little higher. And for the last like 5+ years, and I was always telling all the new guys about this here because it's so weird. Most of these deals are all the same cap rate everywhere. Like you buy something in downtown Chicago or in the furthest out suburb, same cap rate. And same thing, new property versus old, same cap rate. So that was, I guess, fine for people to be buying those deals at the same prices when everything was hot and running up. But now is when it actually matters what you bought. Like if you bought the nice downtown property or in a nice property in an A location, you're going to do way better than the C property in a bad location. So that's going to really matter now. So trade up in quality, look for loan assumption deals. It's going to save all the tips to the end, but let's just give them out throughout this. But so then on the Phoenix front, so that changed from a 3.5 or 4 cap to a 4.5. That would be a 12 to a 22% drop in value. And depending on what happens with growth, there could be more there in terms of drops value wise, where Phoenix and really all the Sun Belt was pricing in a lot of growth. And if things seem like they're good, like rents are just going to be flat or drop, like people are going to be looking to make it on essentially current yield and treat it more like these, they're just be like, I would need to make money, a certain return day one, and we're not banking in any growth. That's going to change the prices more. So let's be on the lookout for that. See what happens with rents as we get into the fourth quarter this year. But on everything we've been seeing in Phoenix, I mean, rents have been holding up nicely. Like I said, the growth is coming out of the market, so things are just kind of more normal now, and we're done with the days of rents going up 20% a year. Obviously, no one thought that would keep going, and I'm saying Phoenix, but really we're seeing that across the whole Sun Belt. Another guy that I was hearing talking, he has a deal tied up in Austin in a pretty far out suburb, and he's got that 12% below peak pricing, and he thinks that's a good valuation to jump in on. So just another data point on being in that, call it sort of 5 to 25% down range, where at 12% he's a buyer, 12% down. So that's what we have for, I'd say, values. And again, big piece of this is debt, sort of how much the debt markets moved since the spring. The banks that were lending money at 3 or 3.5%, they're 5.5 to 6.5 now. Freddie, Fannie, they were similar pricing to the banks, 3 to 3.5%. Let's say for a 10-year fixed yield maintenance type loan. Now you're looking at 5.85 to 6.25, so 5.85% to 6.25%. Fannie and Freddie small balance, that's even higher. Generically, let's say 6.5% is what they're quoting, and this is all live info from today. I reach out to the debt guys before getting this going, and they were all quoting in the 3s before. And it's even worse with debt funds. Debt funds, that's a lender where what they do, they raise money not to acquire properties, but to lend on properties. So they make loans on properties. Rarely is it fixed rate. Normally it's a variable interest. So floating rate is the other term for that. What they do, they pool the money together. They make a loan. Usually then they're actually borrowing against the fund's assets on another line of credit, fund the loan, and then they sell most of the loan. They keep the riskiest piece for themselves. So ideally they sell it, they make a spread. The less risky piece sells at a lower interest rate than the whole loan, so they make a spread on that, or sell it at a premium. I don't have a debt fund. I don't know how it exactly works, but they make money on the sale, and then they keep the riskiest piece for themselves. They're able to um, pull out like a high single digit return doing that. But a lot of lenders, that the debt funds were using, they're pulling back. I'll get to that in a second, but debt funds, they were quoting loans that were SOFR plus 350, SOFR plus 300, and now SOFR was basically zero, and now SOFR is on its way from zero up to 4 or 5%, and they've also widened their spreads because they're worried about how much money they can put out. So like deals today, you'd be getting quoted SOFR plus 400, and that's basis points. So SOFR plus 4%. And right now SOFR is in the 2s and going up. So you'd be starting out in the 6s, looking at this rate going from to 7 and probably 8%. So debt funds are even worse than the fixed rate stuff right now. So I guess kind of lastly, something I picked up on in the conference that I hadn't heard before, but someone I know works at one of the largest banks. He was talking about this Fed stress test, this hypothetical stress test all the biggest banks just went through. Not something that's going to be done on smaller regional banks. So if you're not lending from the biggest banks out there, this isn't going to directly impact you per se, but it does have like down the line effects where the lender that gives a $500 million line of credit to a debt fund, that's not your local bank. That's the big banks that are going through this stress test, and they're having to pull back because they all need to pass this test. Otherwise, they can't buy back stock and do other things that they must do, in their opinion. So everyone must pass. All these banks, they need to pass the test. And the way the tests are being ran, the real estate loans were penalized the most out of all the loan types, it sounds like. So the particular bank this guy works at, they're not making any new real estate loans. They already have enough construction loans and other things that will require more funding that they already are looking, going, our real estate balances are still going up, and we wish they were going down so we could pass this test even with more margin of error, do better on the test and pass it with more room. And also another weird thing is he's saying they're getting no loan payoffs. Like no one's refinancing now because you're just putting a worse loan on it, and then there's not a lot of sales, so there's very few payoffs. So they're not able to. If they want to keep their balance the same, probably normally you get a certain amount of payoffs and then you can make a predictable amount of loans. They're not getting the payoffs. So now they're really pulled back. Trying to keep that anonymous, I guess, to not be putting one bank out there. But I found that very interesting, and that's, going to just continue to have down the line impacts if that's going to make debt funds pull back, and other big buyers or big transactions can't happen without those huge lenders there. So, and then lastly, this wasn't really much of a talking point at the conference, but just kind of obvious to me looking at this every day. But so the Fed is raising rates to fight inflation, and it looked like, with a lot of people, including myself, the year-over-year inflation numbers were going to finally start going down in December of this year. So December 2021 to December 2020, that inflation number year over year, December to December, was 7.04%. And that's, the prior months were all in the 5s and 6s. So we got a big December number. And then when you go and compare December 21 to what will be the December 2022 number, a lot of people were thinking, okay, that's going to be a much smaller increase. And then everyone's going to go, because you have a really high comp you're comparing it to, the next increase is going to be small. Even if inflation is still this, even if prices are the same or going up, you start hitting really high comps once you get into December 2021 or the 2022 numbers. And then the Fed and everyone's going to be able to announce we beat inflation. and we can start cutting rates now. Um, that's not happening. The inflation number is not budging, and it's something we're keeping a keen eye on. And I forgot if it's August to July or September to August, but whatever the most recent inflation print was, it was up by quite a bit month over month. And that's why the 10-year treasury blew out from being at 3% in the threes to all the way to 4. That's let me pull up the 10-year treasury instead of just talking in like generalities here. Call it the start of September, the 10-year treasury had pulled back, actually bottomed at the end of July. Then it came in a bit in August and was all in the twos. And then this big inflation number prints, and throughout September it runs up to breaks through. It hits 4 on September 26 or 3.99, and then it's just kind of staying up there. So that's not, that a lot of people that were still in the market were predicting, okay, this higher rate environment, it might be for like a year. But including the guy who was working at that big bank I was talking to, their predictions, and now it seems obvious to me and others, like this isn't going to just be a 1-year thing. Now, inflation is going to be a persistent problem. The Fed's going to keep rates up. That's going to be supportive of higher treasury yields. And when there's a recession and a lot of uncertainty, people invest in treasuries. So then that should push the yield down, you would think, but it's not happening. So this is going to be more than a quick thing. Like it could have been if inflation was going to get squashed here, prices, maybe they move down from like July to July, but by July 2023, things are, we'll call it back to normal. Like that doesn't seem to be the case here. This is going to be a longer difficult environment. So I guess kind of takeaways, that's where the market's at. For one, have a steady hand. You want to extend your hold periods. If you're going to hold a deal for 1, 2, 3 years, that's turning into a 5 or 7 year hold now, where you got to get to the other side of this and pick up where we left off. Let rates settle down some, the growth pick back up, and let the building values recover. So if you are buying, then now's when the deals are there. Things happen quickly where, let's say this is going to be a 1-year pullback in prices. We're already like 4 or 5 months into it. So if you think it's a 1-year pullback, like it's already whatever, a third over. So, just keep that in mind as a buyer, where if someone has to sell today, they're selling at a discount. Whether there's going to be better deals to come, no one has a crystal ball, and this isn't the predictions podcast necessarily, but it seems like now with this most recent spike up in rates, like now would be the time to start dipping your toe in. If you put something under contract like within the last 2 months, you definitely jumped in too early. In retrospect, obviously, a lot of people, including myself, didn't think the inflation number was going to continue to be this high, and the Fed even more committed to raising rates and squashing inflation. So, and then I think lastly, I already mentioned this earlier, but you want to trade up in quality. So if you are buying, you got to focus on buying better assets, where if things get worse, those deals will hold up better. And then once things go back to normal, not only are you better in worse times, but in better times, you're still selling at usually like a lower cap rate, a better value, because you bought something of quality. So trade up in quality, extend the hold periods, and then be ready to buy when you think we're at a point where it works for you. So thanks for joining us. Everybody, wish this was maybe a better update, but just the reality. I hadn't really talked about this much on the podcast. I had sent something out to our investors about what's going on, but you hear a lot of people where they are saying the market's shifting or it's becoming more balanced. Like it's prices are down. It's a buyer's market. And then whether or not now is the time to jump in or not, that's going to be based on deal by deal, location by location. Again, better quality properties recover quicker. So that's why I'm saying trade up in quality. So if you buy something now, you are likely closer to that bottom and closer to it recovering than a very poor asset. So take care, everybody. We'll see you on the next one. Thanks for joining us.
Thanks for joining us on the Rise and Invest podcast. Please be sure to hit that subscribe button on YouTube or wherever you enjoy your podcasts. If you'd like to dive even deeper into real estate investing, check out our company's website, riseinvest.com, where we have numerous free resources and information that can help both active and passive real estate investors. Our 100-plus page passive investing guidebook, our trends report, and our blog are all available on our website. If you are an accredited investor, you can get started today as a passive investor in our multifamily investment opportunities by hitting the Invest Now button on our website.
The views and opinions expressed in this podcast are those of Drew Breneman and guests as of the date of recording and do not purport to reflect the views or opinions of Rise Invest Holdings LLC and its subsidiaries. The views and opinions are provided for informational purposes only and should not be relied upon or deemed as investment or tax advice or an offer to buy or sell securities, and the speaker cannot be held responsible for any direct or incidental loss incurred by applying any of the information offered.